The number you see on your screen right now, $376.85, is not a glitch, and it is certainly not a quiet Tuesday afternoon for Broadcom shareholders. We are watching a massive, aggressive move to the upside, with the stock tearing higher by nearly 11% in a single trading session. To put that into perspective, for a company with a market capitalization of this magnitude, seeing a double-digit percentage swing in intraday trading is rare. It represents tens of billions of dollars in value being created in a matter of hours. Most people looking at this chart today are going to assume this is just sympathy momentum. They will look at the headlines, see that the tech sector is green, maybe glance at NVIDIA stock, and assume Broadcom is just catching a ride on the general AI wave. That is the expectation, that a rising tide lifts all boats, and Broadcom is just another passenger on the semiconductor ship. Here is the reality. Today's move is not about sympathy. It is about a fundamental structural confirmation that Broadcom has quietly become the most critical infrastructure play in the entire artificial intelligence ecosystem, arguably more indispensable for the next phase of AI than the GPU makers themselves. While the retail crowd on Robinhood and SoFi Invest has been hyper-focused on the companies making the brains of AI, the smart money, the institutional giants managing Fidelity Wealth Management accounts and Schwab Intelligent Portfolios has been aggressively positioning into Broadcom because they understand something crucial. The future of AI is not just about raw power anymore. It is about efficiency, and Broadcom owns the efficiency layer. The catalyst driving this specific price action today is directly tied to reports surrounding Google's Gemini 3 model. The market is waking up to the fact that the custom silicon powering these massive leaps in performance isn't coming from the usual suspects. It's being architected in partnership with Broadcom. When you see a move of 10.77% in a mega-cap stock, it means the market is rapidly repricing the company's future cash flows based on new information. The new information here is that the custom silicon thesis, the idea that big tech companies will design their own chips rather than buying generic ones, is accelerating faster than anyone predicted, and Broadcom is the primary beneficiary. The Great Rotation. Why Broadcom is winning today. Let's dig into the mechanics of what is happening right now on the trading floor. We are seeing massive volume today, significantly higher than the average daily volume of around 20 million shares. This volume indicates institutional accumulation. When you see Interactive Brokers stock trading data or Fidelity Trading Platform order flows showing this kind of buy-side pressure, it tells you that mutual funds and hedge funds are stepping in. The narrative for the last 2 years has been dominated by NVIDIA stock, and rightfully so. They sell the shovels in the gold rush. But investors are starting to look at the Phase 2 of the AI build-out. Phase 1 was buy as many GPUs as possible at any price. Phase 2 is, how do we make these data centers actually work without going bankrupt on energy costs and latency? This is where Broadcom enters the picture. Broadcom does not just make chips, they make the glue that holds the entire internet together. They are the leaders in networking, the switches and routers that allow thousands of AI chips to talk to each other. But more importantly, they are the silent partner behind the biggest tech companies in the world. Key insight: Broadcom's custom ASIC, application-specific integrated circuit business, is exploding. Google's TPUs, tensor processing units, which run their AI, are designed with Broadcom. Meta's custom chips, Broadcom. The rumor mill regarding an open AI partnership for custom silicon starting in 2026, Broadcom. While Apple stock grabs headlines for its consumer devices, Broadcom has been supplying the critical wireless components that make those iPhones connect to the world for over a decade. Now they are applying that same indispensable partnership model to the hyperscalers, Google, Amazon, Meta, and Microsoft. The market is realizing today that as these hyperscalers launch new models like Gemini 3, they are leaning heavier on their custom chips, not lighter. This validates Broadcom's strategy. They're not trying to compete with NVIDIA in the merchant market. They're helping the biggest customers in the world build their own alternatives. That is a stickier, more defensive, and incredibly lucrative position to be in. Breaking down the business, the Frankenstein of tech. If you are new to this name, or perhaps looking at it through your Fidelity mobile app wondering what they actually do, Broadcom is arguably the most complex and fascinating company in the technology sector. It is effectively a Frankenstein monster of tech assets, stitched together by CEO Hock Tan, who is widely considered one of the best capital allocators in modern history. Broadcom operates in two distinct worlds. Semiconductor solutions. This is the growth engine. It includes the networking chips, the broadband modems, the wireless chips for Apple stock, and the custom AI accelerators we just discussed. This segment is highly profitable and grows with the global demand for data. Infrastructure software. This is the result of their massive acquisitions, CA Technologies, Symantec, and most recently, VMware. The VMware acquisition, which closed recently, was a controversial move. Many analysts thought it was too expensive or too messy, but Hock Tan has a playbook that he executes with surgical precision. Buy a company that is critical to enterprise IT, strip out the bloat, focus on the top 1,000 customers, and transition everything to a subscription model. We are already seeing the results. The software segment is becoming a cash flow machine. This cash flow is then used to pay down the debt from the acquisition and, crucially for investors, fund a rapidly growing dividend. If you are using Schwab Intelligent Portfolios or looking for investment help regarding dividend growth, Broadcom is often a top pick because it behaves like a growth stock but pays you like a value stock. However, the integration of VMware has not been without friction. There have been reports of customers unhappy with price hikes and the forced shift to subscriptions. We saw headlines recently about Fidelity itself having some legal friction with Broadcom over software licensing. This is a classic Broadcom risk. They push pricing power to the absolute limit. It's great for margins, but it can alienate customers. Yet today's price action suggests the market doesn't care about the complaints. It cares about the cash flow, and the cash flow is undeniable. The macro context. Why now? Why is this breakout happening today specifically? Aside from the Google news, we have a favorable macro setup. Interest rate yields have been fluctuating, but the general consensus is that we are in an environment where the Federal Reserve is looking to normalize rates. Broadcom, despite being a tech high-flyer, has a significant amount of debt on its balance sheet due to the VMware purchase. When rates stabilize or come down, companies with debt burdens get a repricing to the upside because their interest expense outlook improves. Furthermore, as investors look for investing sites to allocate capital, they are rotating out of pure speculative software plays and into profitable tech. Broadcom trades at a reasonable multiple compared to many of its AI peers when you factor in its massive free cash flows. If you look at the Interactive Brokers trading screens for the semiconductor sector, you will see a sea of green, but Broadcom is leading the pack. This relative strength is a powerful technical signal. It means that even in a good market, Broadcom is the preferred asset. It's outperforming the index, it's outperforming Tesla stock, and it's outperforming the broader chip sector ETFs. The counter-narrative. What could go wrong? I want to pause here and offer a contrarian view, because no stock goes up in a straight line forever. The expectation right now is that the custom silicon trend will kill NVIDIA stock. That is the extreme view. The reality is likely more nuanced. Building chips is hard, extremely hard. While Google and Broadcom have a great partnership with the TPU, NVIDIA is not standing still. They are accelerating their own roadmap. If NVIDIA manages to lower the total cost of ownership for their GPUs significantly, the incentive for Google or Meta to pay Broadcom billions to design custom chips might decrease. Broadcom's bet is that customization always wins at scale. But if general-purpose computing becomes efficient enough, Broadcom's custom ASIC business could face headwinds. Additionally, we have the customer concentration risk. A huge chunk of Broadcom's revenue comes from a very small list of clients: Apple, Google, and a few others. If Apple stock takes a hit, or if Apple decides to finally succeed in building its own wireless chips, something they've been trying to do for years to cut Broadcom out, that would be a massive blow to Broadcom's revenue. Apple has failed to do this so far, which speaks to Broadcom's engineering dominance, but the threat is always looming. Comment below how many shares of Broadcom you currently hold, or if you are holding it through an ETF. Do you think the custom chip business will eventually overtake NVIDIA, or is